Exhibits. Forward contract used to hedge a recognized foreign currency denominated asset, page 222. We now return to the X & Co example, in which the company has a foreign currency account receivable to show the accounting for a hedge of a recognized foreign currency denominated asset. In the preceding example, X & Co has an asset exposure in euros when it sells goods to the Spanish customer and allows the customer 3 months to pay 1 million euros for its purchase. To hedge its exposure to a decline in the US dollar value of the euro, X & Co decides to enter into a forward contract. Assume that on December 1, year 1, the 3-month forward rate for euros is $1.485 and X & Co signs a contract with First National Bank to deliver 1 million euros in 3 months in exchange for $1,485,000. No cash changes hands on December 1. Given that the spot rate on December 1 is $1.50, the euro is selling at a discount in the 3-month forward market. The forward rate is less than the spot rate. Because the euro is selling at a discount of $0.015 per euro, X & Co receives $15,000 less than if payment had been received at the date the goods were delivered, $1,485,000 vs $1,500,000. This $15,000 reduction in cash flow can be seen as an expense. It is the cost of extending foreign currency credit to the foreign customer. 17. Conceptually, this expense is similar to the transaction loss that arises on the export sale. It exists only because the transaction is denominated in a foreign currency. The major difference is that X & Co knows the exact amount of the discount expense at the date of sale, whereas, if the receivable is left unhedged, X & Co will not know whether there will be a transaction loss, or gain, nor the size until 3 months pass. Given that the future spot rate turns out to be only $1.48, selling euros at a forward rate of $1.485 is obviously better than leaving the euro receivable unhedged. X & Co will receive $5,000 more as a result of the hedge. This can be viewed as a gain resulting from the use of the forward contract. Unlike the discount expense, the exact size of this gain is not known until 3 months pass. X & Co must account for its foreign currency transaction and the related forward contract simultaneously but separately. The process can be better understood by referring to the steps involving the 3 parties X & Co, the Spanish customer, and First National Bank shown in Exhibit 6.4. Page 223. Exhibit 6.4. Hedge of a foreign currency account receivable with a forward contract. Steps on December 1, year 1. X & Co ships the goods to the Spanish customer, thereby creating a 1 million euros account receivable. X & Co sells 1 million euros 3 months forward to First National Bank, creating an executory contract to pay 1 million euros and receive $1,485,000. Steps on March 1, year 2. The Spanish customer sends 1 million euros to X & Co to settle the account receivable. X & Co now has 1 million euros in foreign currency. X & Co delivers 1 million euros to First National Bank. First National Bank pays X & Co $1,485,000. US dollar value of the euro receivable, and fair value of the forward contract are determined as follows. Because the settlement date, currency type, and currency amount of the forward contract match the corresponding terms of the account receivable, the hedge is expected to be highly effective. If X & Co properly designates the forward contract as a hedge of its euro account receivable position, hedge accounting may be applied. In particular, because it completely offsets the variability in the cash flows related to the accounting receivable, the forward contract may be designated as a cash flow hedge. Otherwise, X & Co may elect to account for this forward contract as a fair value hedge. X&Co determines the fair value of the forward contract by referring to the change in the forward rate for a contract maturing on March 1, year 2. The relevant exchange rates, U.S. dollar value of the euro receivable, and fair value of the forward contract are determined as follows. Table summary. The heading Accounts Receivable applies to U.S. dollar value and change in U.S. dollar value columns. The heading Forward Contract includes the fair value and change in fair value columns. Account Receivable, Euro. Forward Contract. Date. Spot Rate. U.S. dollar value. Change in U.S. dollar value. Forward rate to 3/1/Y2. Fair value. Change in fair value. 12/1/Y1. $1.50. $1,500,000. $1.485. $0. 12/31/Y1. 1.51. 1,510,000. Plus $10,000. 1.496. 10,783, asterisk. $10,783. 3/1/Y2. 1.48. 1,480,000. $30,000. 1.480. 5,000. Plus $15,783. Asterisk $1,485,000. $1,496,000 equals $11,000 times 0.9803 equals $10,783, where 0.9803 is the present value factor for 2 months at an annual interest rate of 12%, 1% per month, calculated as 1/1.012. $1,485,000. $1,480,000 equals $5,000. X&Co does not pay anything to enter into the forward contract at December 1, year 1, because the forward contract is an executory contract. The forward contract has a fair value of 0 on that date. At December 31, year 1, the forward rate for a contract to deliver euros on March 1, year 2, is $1.496. That means that on December 31, year 1, X&Co could enter a forward contract to sell 1 million euros on March 1, year 2, for $1,496,000. But, because X&Co is committed to sell 1 million euros for $1,485,000, the nominal value of the forward contract is equal to the difference, negative $11,000. The fair value of the forward contract is the present value at December 31, year 1, of this amount. Assuming that X&Co has an incremental borrowing rate of 12% per year, 1% per month, and discounting for 2 months, from 12/31/Y1 to 3/1/Y2, the fair value of the forward contract at December 31, year 1, is negative $10,783, a liability. On March 1, year 2, the forward rate to sell euros on that date is equal to the spot rate $1.48. At that rate, 1 million euros could be sold for $1,480,000. Because X&Co has a contract to sell euros for $1,485,000, the fair value of the forward contract on March 1, year 2, is $5,000, an asset. This represents an increase in fair value from December 31, year 1, of $15,783. The original discount on the forward contract is determined by the difference in the euro spot rate and 3-month forward rate on December 1st, year 1, $1.485 $1.50, times 1 million euros equals $15,000. Page 224. Forward contract designated as cash flow hedge. Assume that X & Co designates this forward contract as a cash flow hedge of a foreign currency denominated asset. In this case, the original forward discount or premium is allocated to net income over the life of the forward contract using an effective interest method. The company would prepare the following journal entries to account for the foreign currency transaction and the related forward contract. Year 1 journal entries: forward contract designated as a cash flow hedge. Table summary: a journal entry with a date at the left on the first row, the debit row, one credit row, and an explanation line. 12/1/Y1. Accounts receivable, Euro. $1,500,000. Sales. $1,500,000. To record the sale and 1 million euros account receivable at the spot rate of $1.50, Step 1 in Exhibit 6.4. There is no formal entry for the forward contract, as it is an executory contract, no cash changes hands, and has a fair value of 0, Step 2 in Exhibit 6.4. A memorandum would be prepared designating the forward contract as a hedge of the risk of changes in the cash flow to be received on the foreign currency account receivable resulting from changes in the US dollar-euro exchange rate. Missing this documentation, the hedge cannot be designated and accounted for as a cash flow hedge. Table summary: 2 journal entries each having one debit row, one credit row, and an explanation line. 12/31/Y1. Accounts receivable, Euro. $10,000. Foreign exchange gain. $10,000. To adjust the value of the euro receivable to the new spot rate of $1.51 and record a foreign exchange gain resulting from the appreciation of the euro since December 1st. Loss on forward contract. $10,000. Accumulated other comprehensive income, AOCI. $10,000. To record a loss on forward contract to offset the foreign exchange gain on account receivable with a corresponding credit to AOCI. Accumulated other comprehensive income, AOCI. $10,783. Forward contract. 18. $10,783. To record the forward contract as a liability at its fair value of $10,783 with a corresponding debit to AOCI. Discount expense. $5,017. Accumulated other comprehensive income, AOCI. $5,017. To allocate the forward contract discount to net income over the life of the contract using the effective interest method with a corresponding credit to AOCI. The first entry on 12/31/Y1 ensures that the foreign currency denominated asset is reported on the balance sheet at its current US dollar value of $1,510,000 and that its change in US dollar value is reflected as a $10,000 gain in income. The second entry achieves the objective of hedge accounting by transferring $10,000 to AOCI as a loss on forward contract. As a result of this entry, the loss on forward contract of $10,000 and the foreign exchange gain on the account receivable of $10,000 exactly offset one another, and the net impact on income is 0. This is the essence of hedge accounting. The forward contract should be reported on the balance sheet as a liability. Thus, the third entry makes a credit of $10,783 to forward contract. Under cash flow hedge accounting, the change in the fair value of the forward contract, which has gone from $0 to $10,783, is not recognized immediately in income, but is instead deferred in stockholders' equity. Thus, the debit of $10,783 in the third entry is made to AOCI. As a result of the second and third entries, the forward contract is reported on the balance sheet as a liability at its fair value of $10,783. A loss on forward contract is recognized in the amount of $10,000 to offset the foreign exchange gain, and AOCI has a negative, debit, balance of $783. The second and third entries could be combined into one entry as follows: page 225. Loss on forward contract. 10,000. Accumulated other comprehensive income, AOCI. 783. Forward contract. 10,783. The negative balance in AOCI of $783 can be understood as that portion of the loss on the forward contract, decrease in fair value of the forward contract, that is not recognized in net income, but instead is deferred in stockholders' equity. Under cash flow hedge accounting, a loss on the hedging instrument, forward contract, is recognized only to the extent that it offsets a gain on the item being hedged, account receivable. The last entry uses the effective interest method to allocate a portion of the $15,000 forward contract discount as an expense to net income. The company calculates the implicit interest rate associated with the forward contract by considering the fact that the forward contract will generate cash flow of $1,485,000 from a foreign currency asset with an initial value of $1,500,000. Because the discount of $15,000 accrues over a 3-month period, the effective interest rate is calculated as the amount of discount to be allocated to net income for the month of December, year 1, is $1,500,000 times 0.3345% equals $5,017. A debit of $5,017 is made to discount expense in the last journal entry on 12/31/Y1. By making the credit in this journal entry to AOCI, the theoretically correct amounts are reported in net income and on the balance sheet, and the balance sheet remains in balance, as is shown next. The impact on year 1 net income is as follows. Table summary: there are 2 amount columns, and the second and third rows have amounts in the first column only, while the other rows have amounts only in the second column. Sales: $1,500,000. Foreign exchange gain: $10,000. Loss on forward contract: 10,000. Net gain, loss: 0. Discount expense: 5,017. Impact on net income: $1,494,983. The effect on the December 31st, year 1, balance sheet is as follows. Table summary: there are 2 side-by-side sections to the table with assets at the left having only 1 row entry. Assets, liabilities and stockholders' equity. Accounts receivable, Euro 1,510,000. Forward contract, $10,783. Retained earnings, $1,494,983. AOCI, $4,234. $1,510,000 page 226. Year 2 journal entries forward contract designated as cash flow hedge. Table summary, 4 journal entries all having one debit row, one credit row, and an explanation line. The 3/1/Y2 date at the left in the first row of the table applies to all journal entries. 3/1/Y2. Foreign exchange loss. $30,000. Accounts receivable, Euro. $30,000. To adjust the value of the euro receivable to the new spot rate of $1.48 and record a foreign exchange loss resulting from the depreciation of the euro since December 31st. Accumulated other comprehensive income, AOCI. $30,000. Gain on forward contract. $30,000. To record a gain on forward contract to offset the foreign exchange loss on account receivable with a corresponding debit to AOCI. Forward contract. $15,783. Accumulated other comprehensive income, AOCI. $15,783. To adjust the carrying value of the forward contract to its current fair value of $5,000 with a corresponding credit to AOCI. Discount expense. $9,983. Accumulated other comprehensive income, AOCI. $9,983. To allocate the remaining forward contract discount to net income, $15,000 $5,017 equals $9,983, with a corresponding credit to AOCI. As a result of these entries, the balance in AOCI is $0, $4,234, $30,000 plus $15,783 plus $9,983 equals $0. Table summary, a journal entry with one debit row, two credit rows, and an explanation line. Foreign currency, Euro. $1,480,000. Accounts receivable, Euro. $1,480,000. To record receipt of 1 million euros from the Spanish customer as an asset, foreign currency, at the spot rate of $1.48, Step 3 in. Exhibit 6.4. Cash. $1,485,000. Foreign currency, Euro. $1,480,000. Forward contract. 5,000. To record settlement of the forward contract, that is, record receipt of $1,485,000 in exchange for delivery of 1 million euros, and remove the forward contract from the accounts, steps 4 and 5 in. Exhibit 6.4. The impact on year 2 net income is. Table summary, there are two amount columns, and the first and second rows have amounts in the first column only, while the other rows have amounts only in the second column. Foreign exchange loss. $30,000. Gain on forward contract. 30,000. Net gain, loss. 0. Discount expense. 9,983. Impact on net income. $9,983. The net effect on the balance sheet over the 2 years is an increase in cash of $1,485,000 with a corresponding increase in retained earnings of $1,485,000, $1,494,983, $9,983. The cumulative discount expense of $15,000 reflects the cost of extending credit to the Spanish customer. Page 227. The net benefit from having entered into the forward contract is $5,000. Exenco has a cash inflow of $1,485,000 rather than the $1,480,000 that would have been received without a forward contract. This gain is reflected in net income as the difference between the net gain on forward contract and the cumulative discount expense, $20,000. $15,000 equals $5,000. Recognized over the two periods.